Real estate is about to change forever, and I don't say that lightly. Warren Buffett's Berkshire Hathaway just pumped nearly $1 billion into the two largest home builders in America. So the Fed is lowering interest rates, and the housing inventory is sitting at a 22-month high. So none of those things happen by accident. Put them together, and it signals a once in a lifetime shift. Now, I don't just study this for fun. I've got more than 3,000 investors in my school communities and my partnership programs, and some of them pay me thousands of dollars to help them find and fund their own deals. And so that means I'm really feel obligated to spot the risks and look around the corners and find opportunities before anybody else does. And so what I'm seeing right now is going to have, I think, a massive impact on the real estate business over the next 12 to 24 months. And if you're prepared, it could be the opportunity of a lifetime. And if you miss it, it could completely wipe you out. So these financial markets right now are really just a house of cards. One wrong move and the whole thing could collapse, very similar to 2008. And the scary part is we're repeating the same mistakes that we made back then. Risky lending practices, inflated prices, and this overconfidence in the systems that we all trust but aren't actually working as well as we might think. Will it be as bad as 2008, or could it even be worse? Nobody really has a crystal ball, but here's what I do know for sure. A correction of some type is coming, and the housing affordability crisis is already at an all time high. So the question becomes, what do you do as an average everyday investor? So I'm going to walk you through some of the major shifts that I see happening right now and show you how you can not only survive these changes, but actually profit from them. So shift number one is follow the whales. So when Buffett moves $1 billion into Lennar and DR Horton, it means something. Those are the two largest home builders in America, and that's not pocket change, even for him. And so he's doing this out of major conviction over what's happening in the housing market. So why would he do that? Well, because America keeps making more people. Our population is growing as a people. We just are making more people, and we're forming households faster than we can build houses for. So Buffett's famous for ignoring the short-term noise, all the ups, the downs, the volatility. He ignores that, and he looks over a long-term horizon, and he makes bets based on what's going to happen over 10 and 20 years. And his bet is really very simple. People will always need a place to live. This is a universal truth. And of course, he's right. Real estate is not going to be replaced by AI or automation or any other new technological advancement. We've been fighting over land since we were cave people, and that's not changing anytime soon. The need for real estate is just not ever going to go away. And that's one reason I'm just so bullish on owning real estate as an asset, because it is a proven asset class that hedges against inflation and everybody needs it. And so that takes us to shift number two. The problem is most people can't afford to buy a home. The average age of a first-time home buyer is at an all-time high at 38 years old. And why is that? Because a 1,400 square foot bungalow in a good neighborhood with a decent school district that sold for, say, 400 grand 5 years ago now costs $850,000. Who can afford that? So, of course, what happens? Buyers are pushed out. They rent longer because they can't afford to buy properties. And so inventory of existing houses builds up, days on markets increase, and yet interest rates drop just enough to keep people guessing. And so the lesson here is stop trying to predict what's going to happen in the next day, the next week, the next quarter, even the next year. You're almost never going to get it right. Instead, zoom out and take a macro look over the next 10 years. The one thing you can bet on is that people will always need a place to live. And that's why I focus on multifamily. It's an affordable asset class that provides housing for the masses. And here's where things get even more interesting with shift number three. It's called the silver tsunami. 10,000 boomers are turning 65 every single day. Collectively, they're sitting on $78 trillion of wealth. A huge portion of that is tied up in real estate assets and small businesses. And they're ready to retire and sell. They want to go play golf in Florida. They don't want the headaches of managing these assets anymore. And that's where you come in. These are these amazing cash flowing assets where you can step in and buy them and make a small down payment, lock in their financing at 5% or less, and then let the business pay for itself over time. So the seller wins with steady retirement income and tax savings because they're having to pay less in taxes, and you win with a deal that never had to go through a bank approval at all. Shift number four is that creative financing is now normal again. So for years, banks had all the control. Sellers demanded all cash or a bank financing from buyers, and they refused to accept creative financing terms. But now properties are sitting much longer. And so now the sellers are starting to listen. They have less control. And so let's go over a real example. One of our clients, Vera, just closed on a 24 unit property for $1.7 million. So instead of begging a bank for 6, 7, maybe 8%, they negotiated directly with the seller and they got a 4% interest rate with just a 250 grand down payment. You cannot get those kind of terms from a bank. So the seller walked away with predictable monthly income along with some major tax advantages. And the buyer, Vera, locked in a below market financing at 4% and then took over this cash flowing property without having to qualify for a bank loan. So deals like this are happening more and more. It's becoming much more common. And if you understand how to structure these creative seller financing deals, you'll have an unfair advantage over the next 2 years, maybe 3 or 4 years. And that leads us to shift number 5. For the last few years, sellers had all the power. They could overprice properties, they could refuse concessions, and they would still get amazing offers. They had all the leverage. Well, now the leverage is swinging back to buyers. That's starting to change. We're seeing sellers accept terms that they never would have accepted even just 2 years ago. Seller carrybacks, longer escrows, more flexible structures. Properties are sitting on the market longer. So sellers are starting to get nervous and they're willing to dance, as we put it. And that's when negotiation power shifts over to you as the buyer. Now let's talk about inflation as the final shift. It's creeping back up. The job market is wobbly right now. The Fed is lowering rates to stimulate growth. Remember, they raised rates to fight inflation a few years ago. Well, now they've gone too far. Now they're swinging back the other way. But that creates even more inflation, which is troubling. On top of that, the tariff wars are actually driving up cost of goods. And so that creates more inflation, and inflation can eat so many investors alive. But if you're locked in seller financing at below market rates, 3, 4, 5%, inflation actually becomes your friend. So think about this. Your monthly payment stays the same at this 4% rate that you negotiated. But rents rise with inflation. So as inflation goes up, then the cost of living goes up as well. And so that gap becomes your pure profit. And that's why the longer you hold real estate, the smarter you look and the wealthier you become. And so that reminds us of the age-old advice of the best time to buy real estate was 20 years ago, but the next best time is right now. So here's the playbook that you're going to follow. So you want to target owners that have owned the property for 20 years or longer. These are small landlords, mom and pop style operators, like multifamilies between 5 and 50, RV parks, storage facilities. And then you give them a 3-option letter of intent. It's an offer structure that gives them 3 choices. One is a lowball cash offer, and 2 of them are clever owner financing options that help solve their problems. And so you can anchor negotiations around solving for income and taxes, not just the price. So you want to line up some lenders, these private money lenders, not banks, and find some JV equity partners, and you can avoid the institutional banks entirely. If you want to learn more about how to structure those kind of deals, you can check out our free school community. Inside, I've got A to Z course on getting started in commercial real estate, and I go through exactly how to create those kind of offers. So in the meantime, I've queued up the next video here where I'll break down what I learned from spending over 250 grand on real estate courses and which lessons actually made me millions. I'll see you in the next one.